Okay, let's unpack this. Today, we are diving deep into the financial heart of Celsius Holdings. Specifically, we're looking at the Chief Financial Officer's prepared remarks for Q3 2025. And this quarter, well, it wasn't exactly business as usual, was it? Lots of huge strategic shifts happening, new acquisitions, big changes with PepsiCo.
That's right. And that's really the core challenge for you, the listener, trying to figure out how all these big moves actually landed on the balance sheet. We're talking the purchases of Alani Nu and Rockstar Energy, juggling distributor agreements, and then some pretty aggressive debt management all happening at once. So our mission here is to understand how these massive, potentially game-changing transactions really impacted the money flow, the cash flow for the quarter ending September 30th, 2025.
Exactly. We need the hard financial data behind the big strategy talk. We want to break down, how they handled that huge revenue growth and how did they manage to actually improve margins? That seems surprising when they're bringing in lower margin businesses. And maybe most importantly, how did they account for that, what was it, a $250 million distributor exit fee without apparently losing any cash?
Sure.
That sounds tricky.
It definitely requires some explanation. So by the end of this deep dive, you should have a really clear, actionable sense of where Celsius is focusing its financial energy for the near future.
Okay, let's jump in. Top line numbers first.
Yeah, let's do it. So for Q3 2025, Celsius reported consolidated revenue. It was approximately $725 million. And yeah, the headline number, the year-over-year growth was huge, like 173%.
Wow, okay, 173%. That definitely gets attention. But for investors, digging a bit deeper, the real story is often in the core brand growth, right? The Celsius brand itself. And the CFO gave two pretty different figures there. This is where it gets really interesting, I think. So the Celsius brand's U.S. scanner growth rate, that's basically what people actually bought at the checkout. That was 13% for the quarter, which is good, solid growth.
Solid, yeah. Driven by, a decent product mix, getting into more stores, that kind of thing.
But then the reported Celsius brand revenue growth rate was way higher, 44%.
Right. And that gap, that huge 31-point difference between 13% scanner growth and 44% reported revenue growth, it's probably the biggest accounting wrinkle of the whole quarter.
Yeah.
And the CFO was pretty quick to explain why that happened.
So why should you trust that 44% number if actual sales at the register only grew 13%? What's making up that massive difference?
Okay, so it's primarily down to year-over-year inventory movements across their customer base. You kind of have to think of it as a low baseline comparison. They mentioned getting a net benefit this year compared to an inventory optimization program they ran with their biggest distributor, PepsiCo, in the same quarter last year.
Ah, okay. So last year they deliberately kind of pushed inventory levels down, which makes this year's comparison look maybe artificially high, like comparing a huge quarter to one they intentionally kept low.
That's basically it, yeah. They also mentioned things like more promotions and international expansion helping that reported revenue number. But that inventory cleanup from last year seems to be the main engine driving that 44% figure. It's like an accounting correction, but it does mean the underlying organic growth is probably closer to that 13% scanner data.
Got it. Okay, that makes sense. Let's shift from the core brand then to the acquisitions. They weren't just relying on accounting comparisons. They brought in these new brands. How did Alani Nu perform without those, inventory quirks from the past year?
Alani Nu just kept powering ahead. I mean, its revenue nearly doubled up 99%. Apparently, that was fueled by really successful limited-time offerings. They specifically called out the Witch's Brew flavor, said it had record sell-through. So you've got that, plus just good organic growth in their core drinks. It really suggests Alani is beating expectations and growing faster than the category.
Strong showing from Alani.
Yeah.
And then the newest member of the family, Rockstar Energy. We haven't heard much about its contribution yet.
Yeah, Rockstar is a bit more complicated, mostly because the acquisition was so recent, right at the end of Q2, beginning of Q3. It chipped in about $11 million in what you'd call traditional revenue in its first month under Celsius. And here's where the accounting gets a little funny because of the way GAAP rules work when you consolidate new companies. Another $7 million got recorded under other income.
Okay, so if you combine those, the total financial impact from Rockstar this quarter was somewhere around $18 million.
Correct. And the CFO flagged this, saying that this kind of split accounting where some contribution shows up as other income, well, that's probably going to continue through Q4. It should normalize, become simpler, starting in 2026. Looking bigger picture, year-to-date, consolidated sales are up roughly 75%. That's about $770 million more. Alani Nu is responsible for most of that growth, while the core Celsius brand Through the first 9 months is up about 12%.
Okay, so that's a lot of moving parts. Integrating two entirely new brands, usually that puts a huge squeeze on profitability, doesn't it? But the margin story here looks surprisingly good.
It really does. I mean, Q3 gross margin hit 51.3%. That's a big jump from 46% a year ago.
Yeah.
And year to date, they've kept it strong at 51.6%, just maintaining margins over 50% while you're bringing in brands that, naturally have lower margins to start with. That really speaks to the power of their operational scale now.
That almost sounds counterintuitive, though. If they're selling more Rockstar, which has lower margins, wouldn't the overall percentage usually drop? What exactly helped them boost it?
Scale. That seems to be the biggest factor. They're getting significant benefits on raw materials just because of the sheer volume they're buying now. They also got help from lapping that inventory optimization program we talked about earlier. And they mentioned a few other things. Spending less on promotions across the whole portfolio and getting a better mix of packs and sales channels. Favorable mix, basically.
But surely there were some headwinds pushing back against that margin improvement.
Oh, absolutely. The main drags were ongoing tariffs, which always affect global sourcing, and, critically, the lower margins of the newly acquired Alani Nu and Rockstar.
Right.
The plan seems to be accept that drag for now. They expect Rockstar's margins to start improving noticeably in the first half of 2026 once they get sourcing and production fully plugged into their system. So it's a bit of patience now for a bigger payoff later.
And what about controlling costs, operating expenses? It seems like it would be chaos trying to integrate two companies.
Well, controlled chaos, maybe. Sales and marketing, S&M, which covers big campaigns like their Celsius Live Fit Go push, that came in around 20% of sales. That's pretty consistent with their strategy, reinvesting for growth. But the real story was on the overhead side. General and administrative, G&A, expenses were kept really tight at about 6% of sales. And that's excluding the one-off acquisition costs. That 6% is down quite a bit from 9% last year.
Wow, dropping G&A from 9% to 6% while you're expanding and integrating two companies? That takes some serious discipline.
It really points to strong cost control, yeah. So their operating income got a nice boost from the higher margins and that overhead efficiency, though obviously some of that gain was offset by the money they had to spend on marketing and integration to set themselves up for the future.
Okay, now let's get to what you called the financial masterstroke, Section 3. This is about the complex accounting around moving Alani Nu into PepsiCo's giant distribution network. This is the part that might shock people who just read the headlines, right?
Exactly. This is where we need to translate the finance jargon into what actually happened. So, as part of moving Alani Nu into Pepsi's system, meaning Pepsi trucks, Pepsi people stocking shelves, Celsius had to end contracts with its previous distributors. And they recorded about $247 million in distributor termination expenses during Q3.
Hold on. $247 million. That sounds absolutely terrible. A $250 million hit to the income statement.
It sounds devastating, I know. But here's the really crucial detail. Those costs are fully funded by PepsiCo. It's part of their long-term agreement. Celsius didn't actually pay that money out of its own pocket. PepsiCo covered it.
Okay, so if Celsius didn't actually spend the cash, why does the expense even show up on their profit and loss statement? How does that work?
Welcome to GAAP accounting. Generally accepted accounting principles require you to record the expense when it's incurred, which creates that big paper loss on the income statement. But the reimbursement cash they get from PepsiCo, that sits on the balance sheet as a deferred item. Then they gradually recognize that reimbursement money is a revenue. They amortize it into their gross sales over the whole life of the distribution agreement. So the bottom line is, Celsius takes the hit on paper now, but their actual cash flow is completely untouched by this. It's a massive investment in future scale funded by their partner, essentially zero cash cost to them.
Wow. Okay, that cash neutrality is key. And that presumably allowed them to focus on keeping their balance sheet strong, which they said was already in good shape at the end of the quarter. And it looks like they moved fast right after the quarter ended.
They did. Very quickly after September 30th, they paid down debt pretty aggressively, took out $200 million, bringing their total debt down to about $700 million. And doing that had an immediate benefit. It reduced the interest rate on their main loan, their term note, by 75 basis points or 0.75%.
Okay, for those of us not tracking bond yields daily, what does cutting the interest rate by 75 basis points actually mean in dollars and cents for the company?
It means real savings. Pretty significant savings, actually. That reduction is expected to cut their annual interest expense by around $20 million, starting in 2026. So it clearly shows they're balancing that huge investment in growth with being financially disciplined. They're literally making their borrowing cheaper going forward.
So the near-term plan seems pretty clear then. keep investing in the brands, capture those savings or synergies from the acquisitions, and keep strengthening the balance sheet. Pay down debt, manage capital smartly. But that investment strategy, it sounds like it means accepting maybe a bumpier road in the very near term.
Exactly right. And that leads us straight into the outlook for Q4. Management was pretty explicit here. They said, look, while the Alani transition into the U.S. Pepsi system technically starts December 1st, most of the financial benefit, that won't really show up until Q1 2026.
Why the delay? If it starts December 1st, why aren't they seeing the payoff right away in Q4?
It just comes down to the sheer scale of it all. They talked about a phase load in. Basically, they're ramping up inventory gradually from Q4 into Q1. Retailers have to reset their shelves, the planograms, build up stock across Pepsi's huge DSD network. It's not like flipping a switch. It's a major logistical exercise.
And the CFO was very clear they expect Q4 to be a noisy quarter. That definitely sounds like code for, well, volatility and maybe some unpredictable
Oh,
results.
it's absolutely code for volatility. Yeah. They expect the numbers to bounce around a bit. Why? Year-end timing effects from promotions, all the ongoing integration work with the new brands, and even just how their biggest customers manage their cash at year-end can affect things. So yeah, you should probably be prepared for Q4 figures that aren't quite as neat and tidy as Q3's.
And that potential noise extends to margins too, specifically. They warned about more pressure on gross margins in Q4 compared to the first three quarters.
Yeah, they did flag potential pressure there. It sounds like it's coming from a few places. Potentially deeper promotions to clear out old stock and manage the transition, maybe higher scrap and freight costs just from the complexity of moving Alani into the Pepsi system and ongoing tariff pressure. The positive spin, though, was the CFO reassuring folks that margins should bounce back, re-expand pretty nicely in Q1 2026 once things stabilize.
And they're not planning to slow down the marketing spend just because it's the end of the year.
Nope. Seems like the opposite. S&M expense is actually expected to be a higher percentage of sales in Q4, maybe 23% to 25%. They're keeping the foot on the gas with the Celsius Live Fit Go campaign and still paying some costs related to setting up the Alani transition. And then finally, looking ahead into next year, a big focus will be just stabilizing Rockstar Energy. That brand's struggled a bit with its identity, so the plan is to fine-tune the product lineup and really clarify what Rockstar stands for to connect with energy consumers.
Okay, so wrapping this up, what does this all really mean for you, the listener? The CFO's remarks paint a picture of a quarter with really strong top-line growth, impressive gross margins staying above 50%, and just continued massive investment in future scale. And importantly, a lot of that investment is being funded by their partner, PepsiCo.
Yeah, the big narrative here is definitely one of confident, really aggressive expansion. Celsius is growing faster than the overall energy drink market. Alani Nu is clearly outperforming even their own high hopes, it seems. And bringing in Rockstar strengthens the whole portfolio, helps them reach different types of energy consumers. They seem to be navigating that huge but ultimately cash-neutral $247 million accounting charge really well, while also focusing on future profit and paying down debt. It's quite the balancing act.
It really is. It feels like an organization making huge, smart, strategic bets right now. But they're also accepting that the real, consistent financial payoff, especially from leveraging Pepsi's network for Alani and improving Rockstar's margins, well, that won't fully kick in until 2026. So maybe the final provocative thought for you to chew on is this. If Celsius has made these massive investments in future scale, and those benefits seem pretty locked in for 2026, how well can they actually manage this noisy, volatile Q4 they're warning about? Can they navigate that short-term turbulence without shaking investor confidence before the bigger payoff arrives? It's going to be a real test of balancing that long-term vision against near-term execution.